Hello, this is Kim Butler. Today's money myth is that life insurance has a horrible rate of return. We hear and see and read this myth all over, and I have been involved in this industry for over 25 years, and I've seen it every single year, probably every single month. It is amazing how pervasive this is, and I'm not really sure why, except to realize that the product that's called life insurance does not exist in any other form. And so when we talk about life insurance and a rate of return, we're not talking about term life insurance. That has basically no rate of return, or we could even say it has a negative rate of return because you're going to pay premiums and then you're probably not going to get the death benefit. And so you've lost the premiums, you've lost the opportunity to do anything with those premiums, and now you've lost the death benefit. When the return on life insurance is mentioned, it is typically about some type of cash value life insurance, and the purest form of cash value insurance is whole life. When this comment is made, this myth that life insurance has a terrible rate of return, the people that talk this way clearly have not studied the product and its effectiveness. And oftentimes you'll hear people talk about a 2% return in today's marketplace on life insurance. And there may be some products out there that only have a 2% rate of return. Just your typical basic whole life insurance product from a mutual company, meaning one that is owned by the policyholders, is going to have an annualized rate of return of 3.5% to 4.5%. Some of them might even be closer to 5%. Now, when I use that interest rate, that is an internal rate of return, meaning after the cost of the death benefit, after the cost of running the company, because mutual companies are run by the policyholders, and after the cost of any commission to the life insurance agent. So in my discussion going forward, I'm just going to use 4%. It could be 3, especially if you're a little bit older or you have health issues. Could be 5 if your insurance company is today projecting a really high dividend. But essentially, if you just look at this 4%, we have to ask the question, compared to what? What is this 4% compared to that supposedly is this horrible rate of return? There's really nothing that you can compare it to that has both the cash value and the death benefit, because there's no other product that has those two things. Cash value of whole life insurance needs to get compared to a savings account, a checking account, or some other liquid type of an account that cannot change in principle, because whole life insurance is a liquid account that you control. It's not designed to be an investment. And so I think when people make the comment that whole life insurance has this horrible rate of return, they're trying to compare it to an investment. And it should not be compared to that. It should be compared to a liquid account. The interest rate on liquid accounts is usually under 1%. It doesn't matter whether you're talking about a savings account or a checking account or maybe even a CD, which clearly is not as liquid as it should be. So when you look at the internal rate of return on life insurance, first of all, make sure that you're comparing it to something that is an equivalent product, cash on cash. So a very common comparison is a municipal bond or a muni bond fund. But technically that's not accurate, because that can move around in principle, whereas whole life insurance cannot. So again, this money myth is that life insurance has a horrible rate of return. And again, we need to be clear that if we're going to apply an average interest rate to it, let's just say it's 4%, that's because this is designed to be a long-term product. And it truly can earn, in this example, 4% per year, but that is over a 30-year period, or even 50 or 60 or 70 years, which is what life insurance is designed to be held for.